Hi there, I'm Russ of the Dapper Dividends universe. Welcome to the channel. We're running a fun experiment in this video, and something that's on everybody's mind is AI. So it got me thinking, if AI can give us ideas about all sorts of things, what about some stock ideas that may be cheap with some specific parameters that I picked? So we're going to do just that with 4 popular chatbots: Claude, Perplexity, ChatGPT, and Google's very own Gemini. So these are all going to be the free versions where you just give your email address. So this is something anybody can do for free. We're going to check it out, and then I'm going to give you my thoughts on their picks and see how accurate some of them might have been. So first up is Claude.AI, and as you can see, it is the free plan. So this is something anybody can do. No money has been involved, other than the electricity and the internet connection you got to pay. But the prompt I'm going to use for all 4 is just this: please give me 3 cheap dividend growth stocks for a long-term buy and hold investment. Starting yield is not a concern, as I am 47 years old and have many investing years ahead. I want these companies to have a 5-year average return on capital employed, or ROCE, so we can see what kind of a capital allocation job the management team is doing with all the capital that is available to it. We want that to be, as my guy Pulak Prasad points out in everything I learned about investing from Darwin, 20%. Because as Charlie Munger said, if a business is earning about 6% return on capital over a long period of time, it's going to be really hard for you to do better than a 6% return on your investment. So we want that ROCE, a 5-year average of at least 20%, a dividend growth streak of at least 5 years, which is a really low bar, an above average dividend compound annual growth rate of at least 10%, and low to no net debt. And then the last part is that these should be very easy to understand companies, and as Warren Buffett says, they should have a durable competitive advantage, or a moat. All right, let's see what you got, Claude. It took about 20 seconds, and Claude gives us number 1, Microsoft, no surprise, ticker MSFT. 2 is Apple, ticker AAPL, and 3 is Visa, ticker V. And it said all 3 companies are easily understandable businesses with products you use daily, possess durable competitive advantages that strengthen over time, and have the financial strength to continue growing dividends for decades. They're perfect for a long-term investor with your time horizon who prioritizes dividend growth over current yield. All right, now we're here at chatgpt.com. We copied and pasted our prompt, and let's see what GPT gives us. So the first one up that GPT gives us is FactSet Research Systems, ticker FDS. Now interesting, it says its 5-year return on capital employed is around 30%. So let's double check that. And I love finchat.io to check out some valuations of a 5-year average variety. And you'll see down here in the lower left, the return on capital employed is 21.1%. So not quite the 30% that ChatGPT said, but we're still in the ballpark and over my 20% threshold that I asked for. By the way, finchat.io is free, so feel free, pun intended, to head on over there and check out some of these 5-year average returns for things like return on capital employed. And it says it has a dividend growth streak of 24 years. Now check this over at simplysafedividends.com, which is not free, but you can try it out for free for 2 weeks with just your email address. And we see they have a dividend growth streak on here of 25 years. So yeah, that's pretty close to being accurate. Although the last 5-year CAGR was 8.2% and the last dividend raise was 5.8%. Still pretty much average, but not that 10% we looked for, but the last 10 years was indeed 10.6%. Then it also gave us Old Dominion Freight Line, ticker ODFL. This is a company that's in my wheelhouse, and I'm liking how ChatGPT has the moat that says network scale and superior service in less than truckload shipping makes it real easy to understand. 5-year ROCE over 30%, which if we check at finchat.io, way down there, actually it shows 36.3%. So it was a little bit off to the downside, but hey, it's still in the ballpark. And then third, ChatGPT gives us Copart, ticker CPRT, which is something that I have not thought about in quite some time. And they do have a very interesting history, as I've heard them talked about on the We Study Billionaires podcast. They run online auctions for totaled and used cars, serving insurance companies, buyers, and sellers. And they are a recent dividend initiator by having a 5-year dividend growth streak. Now I paused the video and I'm back because I didn't think it sounded right, but indeed, Copart, ticker CPRT, does not pay a dividend. So now I'm telling ChatGPT, hey, Copart does not pay a freaking dividend. And look at that. You're absolutely right. Copart does not currently pay a dividend. That was my mistake. Thanks for catching it. Oh, you're so welcome, ChatGPT. So the new pick now is MSC Industrial Direct, ticker MSM, and I do know that they pay a dividend, and they are in my wheelhouse as they distribute tools, safety gear, and industrial supplies. So now they were even kind enough to rank them that FactSet is 1, Old Dominion is 2, and MSC is 3. And then ChatGPT gives us a few quick notes that kind of says that we'd be in a good position to benefit from dividend snowballing all over time, even though these aren't not high yield stocks. And I do like that these businesses are easy to explain to anyone, which helps when sticking to your investments during rough markets. And it even asks if we would like a spreadsheet comparing these metrics like valuation, payout ratio, or total return. Very nice, ChatGPT. Next is Google Gemini. So we put our prompt in and let's see what we get. So based on the prompt I gave, it said it can be challenging as companies with such strong fundamentals often trade at a premium, which is true. And I like that it said while cheap is subjective and dependent on current market valuations, these companies are worth researching further to see if their current price aligns with your investment thesis. And going back to something Warren Buffett says, there are times in the past when he wishes he would have overpaid for some of these quality businesses. So this could be a situation of that. And if they do become way more profitable in the future, then they could be cheap right now, which is subjective. But Gemini gives us Microsoft, ticker MSFT, with a lot of bullet points on each of these. It gives us Apple, ticker AAPL. And then third is Automatic Data Processing, ticker ADP. I was going to say, if it was Visa, say, hey, Gemini, were you copying off of Claude? And last but not least is Perplexity. Now it's interesting, it shows that it's reading Morningstar, Kiplinger, Money.us News, so it went through a lot of sources, and here, based on the criteria I gave, good old Perplexity, we get S&P Global Inc., ticker SPGI, Moody's Corporation, ticker MCO, and one that I've never heard of is Monolithic Power Systems, MPWR. And kind of the same thing that they give the bullet points. I really liked how ChatGPT and Gemini did theirs, but this is just kind of boilerplate, giving you the simplicity and mode at the bottom where it says its business model straightforward, providing credit ratings and analytics that are integral to bond markets, making it a staple for issuers and investors. Although I don't see the ROS on there, so let's check Moody's, which is a Warren Buffett holding. And yeah, if we look at the 5-year average return on capital employed, 21.6%. So that is exactly what we're looking for. And then interestingly, while you're at finchat.io, they take this number from Yahoo Finance, the price target. So this is the average of all the analysts that gave this a price target, $501.35. And the current price is $481.64. So I guess based on analysts, that way it would look undervalued. But if we go to simplysafedividends.com and check their valuation, they show that based on the 5-year average dividend yield, it is reasonably valued with an expected price of $411 to $503. So it's toward the higher end of being reasonably valued and definitely not under, according to SimplySafe. But if you want one more opinion, a popular tool, alphaspread.com, where when you sign in with Google or whatever, you get 3 free look-sees a week. So we'll burn opened one of them up on Moody's, ticker MCO, and it shows that they have an intrinsic value with a base case of $354, so it could be 26% overvalued. And even on the best case, it could be undervalued by 2%. That, I think, means they're baking in 5 or 10 years of positive growth, where the worst case is 5 or 10 years of negative, and the base is if things just remain flat as they are right now. Flattish as a radish, we say. So I put these into a chart, and yeah, it looks okay. Some of it didn't come through as I would have hoped it did. Where Apple, we see that the 10-year CAGR is 8%, 5-year is 5.5%, and the last dividend raise was 4%. And Simply Safe Dividends gives all of them a reasonable valuation except for MSM, which is MSC Industrial, and MPWR, Monolithic Power, which is undervalued. Now that one had really fast dividend growth, 10-year dividend CAGR of 27%. Yield is only 0.92%. So actually, we're going to take a closer peek at that one. But out of all of these, ODFL is on my watch list, MSM, ADP, SPGI, MCO. These are all on my watch list, including FactSet. So that's kind of interesting, but let's take a closer look at MPWR since it has a very nice return on capital employed 5-year average, and the dividend CAGR is well over 20%. So again, Monolithic Power Systems, ticker MPWR, is the one that really grabbed my attention, and it also looks that it may be very undervalued too. When I see semiconductors, I get a little scared off, but it looks like they are actually easy to understand because it looks like they design and sell circuits that convert voltages in electronic systems like cloud servers, notebooks, and 4G, 5G infrastructure. And they also have lighting control circuits for LCD backlighting in devices such as TVs and car navigation systems. So I can understand that. So they've been growing that dividend for 7 years. It's been paid 10 years uninterrupted. And there's those very fast dividend growth CAGRs. It looks like they just raised that dividend a whole heck of a lot. They go ex-dividend June 30th, 2025, as of when you're watching this. Now, the valuation, they show that it's undervalued here on Simply Safe Dividends. And looking back at the 5-year average price to earnings, that's this gray shaded area. So it shows that when the price, which is the gray line, goes above, it is overvalued and will likely revert to the mean. And when it's below, it will likely go back up to the gray shaded area. Now, the dividend yield of 0.92% is well above its historical average, as well as the forward price to earnings of 39.6 is below that 5-year average. Their payout ratios look pretty good, except that free cash flow payout ratio sometimes jumps up a little bit high, but I'm gonna guess that they may have been spending money to grow the business, so that would be a little bit of the wonkiness in the free cash flow. Because remember, if a company is spending that free cash flow to reinvest in itself, then that's going to show lower free cash flow, but they're growing the business. So you can see that free cash flow per share dropped in 2022, but then it shot right back up. So I'm just gonna guess, without diving into this business, that they made an acquisition of some sort to bring in that extra free cash flow per share. Although their sales growth did fall off a cliff, but their total sales going up and to the right, and this is one thing I'm not too hot on, is that their shares outstanding have slowly been increasing, but they did start buying back. Only 48.6 million shares outstanding. That's not a lot. That's why they have a $600 share price, because some companies have billions of shares outstanding. And their margins all look fantastic. The free cash flow margin, 26%. That means $26 out of every $100 coming in the door in revenue is making its way to free cash. And with free cash, what? We can pay a dividend, carry it as cash on the balance sheet, buy back shares, reinvest in the business, make acquisitions, mergers, things like that. So the free cash flow is the lifeblood of the business. And here we see it shows they have no net debt. So Monolithic Power Systems, have you ever heard of this company? What do you think of it? What do you know of it? I actually think I might be putting this on the watch list because, hey, I think the LCD screens and power conversion and backlit, things like that, it's not going away. If anything, it's going to keep growing. So this is a company that I may indeed be looking into a little bit deeper in the near future. So this is so important that I actually had to change my shirt to make this point, is that this experiment shows that AI is great for generating ideas, but you can't rely on it completely, because ChatGPT even suggested a stock that doesn't pay a dividend. And remember that AI AI is a tool that can't predict the future any better than we can because the stock market is driven by billions of people making billions of decisions every single day. There's no shortcut to smart investing. You've got to do your own research and educate yourself. And if you don't want to, it's cool because remember that 92% of professional fund managers can't beat a simple S&P 500 index fund like VOO over 20 years. So the almost unbeatable easy button for the average investor is to just buy a broad-based, low-cost index fund, dollar cost average into it over time, and reinvest those dividends. So I want to know in the comments below, what cheap dividend growth stocks are you watching? How are you using AI to help you invest? Hey, I wanted to remind you that I have a free and fantabulous weekly newsletter that you can sign up for at DapperDividends.com or click the link below. Share some investing thoughts and insights, the portfolio moves, and some stocks about to go ex-dividend. And if you want to see the portfolio and when I buy stuff that day, you can follow me on Blossom. That's also free. I have a link below, and hey, if you sign up with that link, I get like $5 each time, so win-win for you and I, right? Hey, in this floating little box next to my head, I'm doing another experiment. We're all about the experiments around here, this time using Joel Greenblatt's magic formula dividend style, so I think it's kind of fun. You might find it interesting. Leave this a thumbs up on your way out if you enjoyed it, and if you click that floating little box, I'll tell you all about the magic formula experiment there.